how high are interest rates going? Your guess is as good as mine at this point, as the bond market, interest rate market, has been the most volatile that it's been in years the last couple of weeks here. But thankfully, we can get you some good context for how high rates could get theoretically, how high they could get historically, and how high traders are thinking they could get in the coming days, weeks, and months. We have here a chart of the 10-year. We're going to be talking primarily about the 10-year U.S. rate, as it is a benchmark for interest rates here. Highest since 2007 at 4.25%. First time in over a decade that we've seen Treasury rates in the 10-year duration get this high. You might say, oh, well, the Fed, I heard that they hiked rates over 5%. Yes, they have. We've been over 5% in terms of that short-term interest rate that the Fed controls. But now the rest of the yield curve here in the U.S., the 5, 10, and 30-year part of the curve, finally starting to climb up close to 5%. We're as close as we have been in the last decade, plus to 5% here today. Now, that being said, how high can we get? Well, historically speaking, we could get a lot higher. Theoretically speaking, we could get, as high as, 10, 15% going back to, the full scope of U.S. interest rates. But looking at the last 30 years, which might be a good measure of what's contextually realistic here, we've been as high as 8% in the early 90s. Now, it's been a general downward trend over the course of the last 30 years here. But theoretically, we bottom out at about 0% interest rates. Of course, those in Japan might say, well, actually, you can go negative. We've gone negative. In the U.S., we haven't really toyed around with that. So theoretically, you put the lower bound around 0% there for interest rates. And then over the last 30 years, the upper bound is around 8%. And we're only around halfway there, which makes this a really interesting inflection point here. Makes you think, okay, well, if we're going to live by the interest rate environment post-financial crisis, as you see, around 2008 is when we go from 4% being the low for interest rates to 4% being the high recently, post-2008. If we go back to that pre-financial crisis environment, then 6% is realistic. 8% is that high of the early 90s there. But we'll see. We haven't been eclipsing this 4% marker consistently since 2006, 2007. And even then, from 2002 to the financial crisis of 07, 08 there, they weren't screaming higher than 4%. It's really been the high, not even just since 2007, but since the early 2000s there, have not been much higher than 4%. So historically speaking, we can get as high as 8, even 10% if you go back to the 80s. But over the course of the last decade, this has been the high, and even going back to 2000 have not moved that much higher than 4%. Now, let's rope in some of the current market estimates around interest rates to see where traders think rates can go. Because, the Fed has short-term rates at 5.5%. And right now, going into the end of the year, we have a few months left yet here. The market expects rates to stay high. You can see here in the distribution of where traders think the Fed will have interest rates at their last meeting of 2023, about 60% think that we'll stay right where we're at. And on either side, we usually judge this thing by, okay, here's where we're at now, and is the bulk of the remaining probability on the rate hike side or the rate cut side? And we've been going back and forth the last couple of months You might remember, in March, April, a lot of the market was predicting interest rate cuts by the end of the year, and a good amount of interest rate cuts in 2024. That chance has been dissipating and has been shifting to the interest rate hike side, as now we have about a 35% chance that the Fed hikes interest rates at least one more time by the end of the year. And there's an outside chance of about 4% that they hike twice, up to 6% by the end of the year. And so you might be saying to yourself, well, Frank, you were just talking about 4% or 4.25%, or the 4 to 5% range for 10 years, 10-year interest rates going back the last couple of decades. Now you're talking about 6% here. Well, the yield curve has been inverted. And so what does that mean? Short-term interest rates have moved higher than long-term ones, as the Fed has short-term interest rates right now at around 5.5%. 10 years, though they've been climbing to historic highs, still only around 4.25%. So what does this tell you? Well, we still have not seen historically a yield curve inversion that hasn't normalized, that hasn't come out of inversion. And historically speaking, these inversions usually normalize in a way that all interest rates move lower, but short-term interest rates move a lot lower than long-term interest rates. We haven't seen that. And if anything, actually in the last couple of weeks of the 10-year moving towards its highs, of interest rates moving higher in general, this inversion has come out a little bit with interest rates moving up, which, like I just said, we haven't seen. We usually see the inversion come out with interest rates moving lower. What does this all mean? Well, if the Fed has short-term interest rates right now at 5.5%, they move them to 6% by the end of this year, and they keep them in that level, and the yield curve inversion does normalize like it historically has, well, long-term rates could move even higher. This is almost a case for, if you think that the Fed is going to keep rates at 5.5% or move them even higher to fight inflation further, and this yield curve inversion will come out, well, then that might be from the 10-year moving up above 5.5 or 6%, which it historically has, like I say, in the 90s there. And then you start to look at where the flip side of this could be, right? Because this isn't just a case for rates moving higher than 5 or 6%. There is a case for rates coming back down to 3 and 4% here. And it would be that piece that I was just alluding to, that the inversion could come out with rates on the whole moving lower. And the market is still pricing in that by the end of 2024, the Fed has short-term rates in the 4 to 4.5% range. And so maybe the inversion comes out with the 10-year staying around where it is right now and short-term rates just moving lower. But in the short term here, the market futures traders thinking that interest rates are going to move a little bit higher, and we have the 10-year moving to fresher extremes since the early 2000s as we speak.